Okay, well, good morning, good afternoon, or good evening, depending on your perspective on the world. And welcome to the Trading Coaches Corner. So, good afternoon, everybody. And this is Brandon Wendell with you. I'll be your host for the next hour as we go through my topic that I decided on today, which happens to be the fundamental analysis for traders. So, we're going to take a look at some of the things we can do to increase our odds when we're looking at big picture. Obviously, as a day trader, fundamental analysis really doesn't play into what we do. However, when we look at bigger picture and higher timeframes, we definitely want to play a little bit into that. And, we'll get into that in a moment. Before I do, though, I do need to remind everybody, we are not broker dealers or investment advisors. We will take a look at this information, but from an educational standpoint only. I'm not telling you to buy, sell, or hold any particular securities or giving any personalized recommendations. There's always risk involved in the markets, and we can just try to minimize the risk and manage it, but we can never eliminate it, unfortunately. So we have to deal with that. There's always possibility of loss. And we're not subject to trading restrictions. So I could have a position in security and initiate one at any time. So good afternoon, Jim. Good morning and good afternoon, Jennifer and Kevin and Helen. Good morning. So welcome, everyone. A nice little group here today. Let's see. We've got a lot of things going on right now at Wealth Builders. We got Monster Market Movers. We got Trading You, Mastering the Trade, Trade Watch Alerts, Q&A. So tons of stuff happening. I also want to make a special announcement. One of my friends has now joined the family, which is kind of cool. I'm excited about that. Sean Reed, who is a great person and a personal friend of myself and my wife, has joined us, and he's doing something called Vega Spread Mastery. And they meet 3 times a week, as you can see, Mondays, Tuesdays, and Fridays. And yep, there's the link right there. I actually want to go to his webpage real quick. Sorry, I got so many things I was working on today. There we go. And just kind of show you, it's obviously, when we talk about Vega, we're talking about options. I know I have an option program myself, which actually that's the one I'm showing right here, which is SPX cash flow. I'll talk about that later. But, when we're talking about Sean, let's see. Oh, you had an awesome class with him this week. Great trip. And Rajesh said Sean Reed is a master in options. Yeah, he's very well versed in options. He actually used to run a trading floor, believe it or not. So he actually supervised traders. So he can not only help you out with understanding the options, but understanding your own personal psychology and help you with your own training and trading when it comes to it. So he's very experienced and loves to teach, very well spoken, very easy to understand, great guy. So anyway, you'll learn more about volatility and how to handle volatility. So it's called the Vega Spread Mastery. And as usual, there's always a 2-week free trial when you enroll for the quarterly subscription. So the link is already up there. Miguel put it up for us. So if you end up subscribing there, I guess you have choices, obviously, between the quarterly or the monthly subscriptions. I'll get there in a moment, but talks about how to chart spread premiums, how to create yield with versatility, lots of good stuff that goes beyond some of the simple things when it comes to options to increase your odds for success. So I want to welcome Sean to the family. As I said, I'm kind of proud that a friend of mine is joining me here and real happy about it. And, oh, you were in the class this morning, Daniel? Great. And he says he highly recommends it for others. Oh, that's awesome. Good to hear. Yeah, I got to jump in there myself, to be honest with you. I haven't been there yet. I was in one of his workshops. There it is. You got the monthly subscription or the quarterly subscription. And again, you get the 2-week free trial in the quarterly subscription right now. So they dropped it a little bit. That's just a new program. We usually do that. So as you can see, that early bird pricing does end in a couple of weeks here. So if you're interested in testing the waters and learning more about how to trade options properly, then that's a great way to look at it or to get involved right there. Try it out. You get to kick the tires for free for 2 weeks. So if anybody has any questions regarding that, let me know. Otherwise, I'm going to go ahead and move on here a little bit. And basically, as I said today, we're going to be talking about the fundamental analysis. I know I'm very heavy on the technical analysis as you look at some of my trades I'm watching here. And even probably take a look, see what the market's doing right now. Pretty much nothing, isn't it? I didn't see the NASDAQ today. Still sliding a little bit here. Let me go and clean that up. But really, when we're looking, oops, that's not what I want to do. I want to remove the drawings. So when we're looking at fundamental analysis, we're again not talking about short time frames. We're usually viewing the impact that things are going to have on us from a daily basis or larger. Fundamental analysis will impact the overall direction of the markets longer term. And it's not just the indexes, but it also affects things like crude oil and the agricultural markets, and a lot of that we focus on. The way we get that information fundamentally is from news, obviously. So there are news announcements that come out on a regular basis. And for better or worse, I've been using Forex Factory for many, many years. And here's where I've learned a little bit about some of the impacts that some of this news and fundamental analysis can have on the individual futures that I'm trading. Now, again, it's not just futures, but we can also look at the individual security stocks, because they're obviously going to be driven by fundamental news as well. We'll talk about where to get some of that and how to interpret it. Of course, if you have any questions, keep it to yourself. I don't care. No, I'm kidding. If you have any questions, please ask, and I will try to do the best I can to answer those or find the answer for you. Forex Factory is free for this portion of it. I know there's probably some more paid versions that offer you some new tools, but for the most part, I stick with the free stuff. Yeah. So, today we don't really have any major impactful news. So we can take a look going forward. And it's nice. What they do is they show you, actually, forward is a weekend and a holiday on Monday for the US. You can see bank holiday for Canada and the US. What is it in Canada? Oh, Family Day. Interesting. Okay, we have the President's Day holiday in the US, as you can see. But what happens is they color the news impacts based on the importance to traders and to basically how it's going to impact the price. So I'm going to go ahead and just look at the United States and apply that filter. And again, this part's all free. I'll also look at the entirety of next week. There we go. So you can change the dates. You got a lot of things you could do here. So the first one that comes up that's supposed to have a high impact is Flash Services PMI. Well, the nice thing about this site, again, it's free, but also when you click on the detail, it gives you a little blurb and it tells you why traders care. It's a leading indicator of economic health. And it also tells you some of the notes. How is this going to tell you what's going on in the economy? Well, above 50 is industry expansion, which means the economy should be growing. And of course, below 50 is industry contraction. It doesn't necessarily mean recession, but there's contraction in the economy, and especially in industry, which is a leading factor of our GDP. Now, when it comes to fundamental analysis, there's a lot that goes into it. We're trying to figure out what's going on with the overall economy, what's going on with individual industries, what's going on with individuals, I should say sectors first. Actually, let's do this. Microsoft Word. I'm going to create some notes as I talk, so it's easier to do that when I write them down for you. There we go. So with fundamental analysis, basically, there's a lot of things that we're looking at. I used to call this the fundamental unicorn because it almost never exists. Okay. What we definitely want to see when it comes to economies, first of all, there's kind of a pyramid when you're looking at fundamental analysis. You're looking at the overall, the country. Actually, we can even look at global. We really kind of need to look at the global economy because honestly, we live in a global economy. What happens in other countries affects what happens here in the United States, where I am, and affects other countries that you may be in. So most companies, especially multinational companies, these large companies are affected by economies all around the world. And we saw some of that last February with the invasion of the Ukraine and how it rippled through the markets and even through certain economies as well, and gave some trading opportunities as well as some investment opportunities. So we have the global economy, then we have the country economy, which is the country that you are deciding to invest or trade in. Under that economy, we can take a look at sectors. Oops. And it depends on where you look, but typically there's 11 sectors. Sometimes they're divided only into 9, sometimes they're divided into a little more than 11, but overall it's kind of accepted that there are 11 sectors to the markets. And actually, there's even different, before we even get there, different assets. So when we're dealing with asset classes, we have things like bonds, stocks, commodities, currencies, and digital. I'll just call it crypto. Okay, so obviously there's going to be different effects that ripple through those different asset classes. Am I missing one? Options, I guess, are now asset class too. I don't think there's anything else, but I think we're okay. Anyway, under the sectors, we have industries. And there's over 200 industries. I don't know the exact number. Again, it depends on which website you go to kind of see, but the sectors can be subdivided into these smaller industries that are a little more specific as to what these companies do. And then, of course, we have leading companies. And those leading companies may be the bigger weighted companies when it comes to indexes, and they have a big influence on some of the following companies. So, you can go through this whole pyramid, and you probably should when you're doing your long-term analysis to find the best opportunities and what's the most probable future direction for whichever market it is that you've chosen to invest in. So when we're looking at the financial unicorn, we mentioned that. And let me separate this a little bit here. There we go. So I'm going to go to a website that's also free. You'll see I had a theme. I love free websites. And this one is Trading Economics. And they probably changed it since the last time I've been here because, unfortunately they did. That's okay. If you look down a little bit, actually, this is what I was looking for right here. And basically what we're looking for the unicorn, we want to see that the economy we are investing in is growing. And one of the measures of economies growing is GDP, gross domestic product. It's basically the report card or the output of a country. Is it expanding or is it contracting? And if you really want to get more involved in this, you can actually dive in to see what makes up the GDP. What really does the US produce? And honestly, it's debt. That's really the biggest production. We produce debt. We have money managers and things like that and lenders. The way you can find that out, what is the big driver of the GDP, believe it or not, is the CIA Factbook. I think it's ciafactbook.com. Nope, it's not. So let's see here. Just do a search here. It may be a .gov website. It's been a little while since I've been there. Yep, it is CIA.gov, the World Factbook. And it gives you a lot of good information about the different countries and economies. So right here, I can go into countries, for instance. We'll go down to U, and there's United States. So I don't care about the photos, country flag, blah, blah, blah. But we can go into economy. And they have an overview of what's going on there. They talk about the GDP as well, the growth rate, and they changed this around. They made it kind of flashy. It's nice. Trying to see if they actually show the breakdown. There we are. And there's the GDP composition by sector. And you can see services is number one by far, 80%. And again, it's really kind of the issuers of debt, if you will. Agriculture, 0.9%. We are not an agrarian economy by far. Industry, it's growing a little bit. It's getting better, but we're still under 20%. And you can see that household consumption is the end use. So it tells you what we produce, what the major industries are. So you can learn a lot about a country and, what are the major drivers for that economy by looking at the CIA Factbook, which is kind of neat. So getting back to this unicorn, so to speak, we want good GDP growth year over year and even quarter over quarter, but year over year is probably more important for long-term investment. So for the financial unicorn, we want GDP, good year over year, which might as well type it out, growth. Now, if you're not aware, the to go into recession, officially a recession is 2 quarters of negative GDP growth. That's the official recession. And it's the NBEA that actually announces whether or not we're in a recession. So there's a panel, I think it's 9 people on the panel, and they'll do the announcement. It's always lagging, by the way. You know, by the time the GDP numbers come out, because there's 2 numbers we get released. We get a preliminary number, and then we get the final number. Okay. And the preliminary number doesn't usually change before the final, but it can. Okay. So if we happen to get 2 quarters of negative GDP growth, we are now in a recession officially. And of course, it is always going to be late. So for the unicorn, we want to see good year-over-year growth. And of course, good quarter-over-quarter growth would be helpful as well. Well, pretty much for the unicorn, it's all right across here. When you invest money in a country, you also want to get a good return on your investment from your money. So if you invest in the currency, we would look at the interest rate. And what we want to see here typically is a good or high interest rate. So we want to see a high interest rate and possibly rising. You got to realize when you want to invest in a country, you have to convert into that country's currency, and the profits initially are going to be paid back in that country's currency. So if that currency is strong, then you're going to be getting a good return on the currency because of the interest. If the currency is weak, there's probably going to be some low returns and low interest. You're not going to earn as much on your money. So you could get good individual returns on an investment like a company, but if the currency is not giving good returns on the interest rates, by the time you repatriate your money, basically bring it back to your local currency, you could actually lose. So that's something that people don't really pay too much attention to. The nice thing is, if you want to invest in other countries, you don't necessarily have to convert your money to the other country. You can, and that's probably most of what people will do, but it's not always necessary. There's a lot of countries that their companies are dually listed. They will be listed on both the United States and on their local economies exchanges. And you could find those, actually FinViz is a good resource for finding those if you want. So if I go out to FinViz, there is a map of the market right here. So I'll click on that map. And let's see, which one am I looking for? World, right there. And now you see, this is the map showing all of the Canadian companies that are listed in the United States stock market, or all the Mexican companies, or all the Cayman Island companies, or South Africa, and so on and so on. So if there are companies that are home based in another country, however, they are dually listed in the United States, you obviously don't have to exchange your money to invest in those. You can buy them by purchasing those ADRs or ADSs. Okay, if you're not familiar, ADR is American Depository Receipt. Technically, you don't own the stock. You own a receipt for the stock that's listed on the other exchange, but it trades pretty much like a stock. You won't notice the difference too much. Okay, so there, if you want to invest in Norway, so you can see Israel, lots of different countries have dual listings. Maybe they have some work that happens here in the United States. You know, they do some business here, accounts receivable, whatever, or they just want to be dually listed. So they do that. So FinViz has a resource in the map of the markets. You just go to World and you can find some of those. That way you reduce the currency risk if you happen to be in the United States, and you can still invest globally. So if you want to take advantage of something booming in China, not right now, although that's one-day performance, we could take a look at, say, 6-month or even yearly performance. And we see Germany looks somewhat strong, SAP, Deutsche Bank, although a lot of red over there in some of it too. Anyway, getting back to our unicorn. So we have GDP, interest rate. Now, what cuts into your investment is inflation rate. That's a real problem, because even though you may be gaining on your interest, again, if you own that currency, interest is what you're earning. Inflation is what you are giving up. It's the lowering of the purchasing power. So even though the United States has a 4.75% interest rate, we're actually negative on the investment right now because you are losing more with inflation and your purchasing power going down than what you're gaining on interest. So if you were to put your money in a US bank, first of all, you're not going to earn that much, but even a CD, if you happen to capture 3-4%, you're actually losing money because your purchasing power is dying at 6.4%. So we would like to see a low inflation rate. Okay. And this becomes some of the problem because typically if inflation is high, right, you raise interest to kind of combat the inflation. So you should see that, but it sacrifices GDP, right? Because if you raise interest rates, that's what the Federal Reserve does. They control those interest rates. If they're raising those, they're doing that to slow down the economy, and that's going to hurt the GDP overall and start to slow it. So that's why I'm saying this is a unicorn, because some of these work against each other. And it's going to be very rare to find the best of the best in all the categories. It just doesn't happen. So we do what we can to find one of the better of the candidates when it comes to countries this way. So again, we want low inflation, and there's a lot out there that are very, very high, and there's some that are low. You can actually search right now, Russia, 11.8%, UK, feel bad for the people, earning in the pound there. You can even see Italy is very bad. The United States looks pale in comparison to those. But you flip it the other way around, China is only at 2% and their interest rate is 3.65. So that means that the Chinese renminbi should actually be earning interest for you, and therefore should be gaining a little bit of strength versus currencies like the US dollar. Well, let's take a look. We go over here, USD, we go to currencies, and it's under CN, they call it the Chinese yuan, but it's renminbi yuan. And we go out to daily, and you can see overall, the US dollar was diving. It's finally bouncing a little bit, but we're coming into a little bit of supply here that might push prices back down yet again. We can go out to a weekly basis here too. And you can see that since October, the US dollar has dove quite a bit against the Chinese renminbi. You can't trust the Chinese numbers. It's the one thing you're not able to. Yeah, you got to be careful about how they're being reported. Obviously, you can only trust the sources so much, especially in election years. It goes for everybody. But overall, you'll normally see money will typically flow into countries that give you better returns, meaning they have high interest and lower inflation rates. It's not always the case. Okay, there's other factors in there as well, but typically that's what you're going to see money flowing into on average. So we want to see low interest rate, high interest rate, low inflation. Okay, and then the last one, can't trust the US number either. I know these numbers get manipulated. They definitely do. I'm not going to say Republican or Democrat or whatever. It's just in general, numbers get manipulated to help certain people get into power or stay in power. Anyway, the last one is going to be, it's right here, jobless rate, unemployment. We obviously want to see low unemployment. Low unemployment leads to greater GDP because there's production. But again, unfortunately, low jobless usually leads to high inflation as well, because people have money to spend. More money to spend, the purchasing power goes down, hence the unicorn. It's almost impossible to find all of these. So we typically want to see a low jobless rate. Okay. Let's see, are inflation rates covering the same basket of goods across countries? I'm not sure, to be honest with you. That's a good question, because if the core rate or even the normal rate that's being shown is over different baskets of goods, then the numbers will definitely vary. So I'm not sure who's putting out the numbers and what they're using, but I think there's an accepted accounting practice that most of the countries typically use, which would be a sample of the same basket. That's my understanding, but I'm not 100% positive on that. So it's something you might want to look at. Anyway, this is the financial unicorn. If you can find somebody or a country, that has really good growth on their GDP, they have great interest rates that are they're paying out on their money, low inflation and low jobless rate, good luck to you. Like I said, it's a unicorn, but if you can, or find one that's pretty good in most of those categories, typically that country is going to be doing well, and the investments in that country will also be paying you well and getting a good return on investment. So fundamentally, that's something that we're typically looking for. And again, you can use this site if you want to, and just kind of search through. Let's see, Brazil has good interest rates. They have low inflation in relationship to the interest rates. They have growth on their GDP, but their jobless rate's a little high, 8%. That's one of the leaders, it looks like. So that could be a bit of a problem. However, we can even look at this from a currency standpoint, or again, the individual countries. I go to my world map. There are Brazilian companies like Valle, what is this? Petro Brasilio, and some of them are bright green for the last 6 months. And we can go out a year for longer term, obviously, and not necessarily as good. There's a few shining stars there, but overall, that economy, and you would want to see what that sector looks like in those individual countries as well to see where's their exposure. If their exposure is predominantly in that country, then they should be benefiting from what you're seeing here. Low inflation, high interest rate, and good growth for the economy, period. So we can also, again, instead of looking at companies in that country, look at Forex. So if we go out to Brazilian real, there it is. Yeah, it doesn't look like it's doing much on the weekly. You see, we're just back and forth going sideways. Let's try this on the daily. And the US dollar, now I'm charting the US dollar versus the Brazilian real. So the US dollar is losing value, the real is gaining value. So therefore, again, it looked like Brazil had better economic numbers. Sorry, wrong one. There we go. Some better economic numbers than the US because they have GDP growth, very high interest. They're a positive on the interest versus inflation by about 7% or so. I don't know the exact number. The jobless rate obviously hurts them. Most GDP growth, India. But they're neutral in the interest rate versus inflation, and jobless rate is very high. So that's going to hurt the GDP longer term. So if the INR, well, you can take a look at that versus the US dollar. By the way, here's the US. GDP year over year is very slow right now. At least it's not negative. Okay. Interest rate is negative compared to inflation. Therefore, you'd expect the dollar to be weak. Joblessness is very, very low. That's a good thing. But again, that could be very underreported as well. It's manipulated, unfortunately. The real jobless number is much, much higher than that. But again, looking at these currencies, Indian rupee. Well, the US dollar is gaining a little bit against the rupee. Let me take a look at the bit longer term view. Surprisingly, the US dollar is doing better against the rupee. And again, it's not really the best investment, even though it has very good GDP. Quarter over quarter, it is slowing a little bit, and they're neutral in the interest rates, and the jobless rate is really hurting them. So, as far as countries go, that's one way of looking at this to kind of figure out, what's going on here with those. Which country should you start looking at to invest in if you choose? And that's one way to do it. And again, good luck finding the unicorn, but you can try to find the best out of all these. All right. And when it comes to sectors, looking at those sectors, again, we can take a look at a lot of different things. Yeah, there's a lot of good websites out there. I used to have a list. I need to put that together again for my E-mini think tank. Or really what I do normally is I look more at fundamentals when I'm looking long-term, and most of the longer-term investing and trading that I do it in two ways. One, I do it in currencies, and number two, I do it using spread trading because it reduces the risk. So you'll notice I'm actually working on my video today too. That's why I was looking earlier this morning at spreads. A spread, if you're not familiar, is simply trading one security against another related security. You can do it with stocks. Typically, it's done, though, with futures and predominantly with the the commodities, such as, or even, no, not just commodities, but yeah, more of the agricultural commodities. So right here, I've got soybeans versus Kansas City hard wheat and looking at a spread trade there. And when I'm looking at spreads, we also want to look at something else from the fundamental standpoint of, and I've talked about this before, seasonality. Because anything that's grown or slaughtered, I guess that's grown to the pigs and the cattle. But even stocks go through seasonality. They have a spring where the prices are starting to go up. They get the summer, full bull market. You get the autumn where things are starting to turn. And then you got the winter where you're full bear market. So I've shown this before. I have several resources I actually use for that. One of those is MRCI. And then that one's probably one of the least expensive resources. This is, you do have to pay for seasonality, unfortunately. So with seasonality, I think I'm already logged in. I'll just show you. If you're interested in MRCI, you can go under purchase subscriptions. If you end up doing a yearly subscription, you can get a 10% discount. So just full disclosure, I do get one free month for anybody who signs up. That's the little spiff they give me for promoting it. So basically, if under source, you have to say the word wealth for wealth builders and my name, Brandon. So this is for mrci.com yearly. Online subscription. Now, don't go out and buy subscriptions if you're not going to use them. Okay. Oops. Under source. But wealth and Brandon, there you go. So if you're interested, you can go here. If not, like I said, it doesn't matter. But right here, I can go, and this is only on futures. So if you're not trading futures, obviously that's not going to help you much. But if you do go to futures, there are seasonal patterns that you can view. And basically what they're doing is they're looking at the charts over the past at least 10 years, usually 15, even up to 25 years. Oops, I put that to the wrong one. Put that to everyone. There we go. Oh, no, I didn't copy the text. Typed out this whole thing and just put it the wrong way. All right, so let me do it again. % off code. There you go. Now you can see it. So anyway, like I said, if we want to take a look at the indexes, I go to indexes. We can take a look at the index itself or the individual futures contracts. I'm just going to go ahead and look at the index, and we'll go to the NASDAQ. So looking at the NASDAQ, we're going to see the seasonal patterns for the last 5, 15, and 30 years. Now, it's not guaranteed to follow those patterns, but it's a high probability, because the nice thing about this is the big players in the markets tend to follow these. So if the big players in the markets are following this, then it's likely to be following through. So we can see right now in the equity markets, we are entering into a bearish time for the NASDAQ. Until the second week of March, it looks as though we should be looking for bearish opportunities, at least in the last 5 years. Last 15, not so much. Last 30, no. But in the last 5 years, something's changed in these markets so that overall the move has been to the downside. Well, that's a good thing to know, because if we were thinking of buying into the NASDAQ or into securities in the NASDAQ, the overall index might be taking a dive for the next couple of weeks, and we may need to hold off on our purchases until we have a better price area. And that's something we can look at. We can also, again, take a look at the NASDAQ or divide it up into either sectors or even industries to figure out which is the best performing and what's going on with those. So the nice thing is, not only do they give you the charting and show you the overall, the movements seasonality wise for these securities, but they actually give you descriptions and reasons why behind it as well. So if I go back to MRCI online, I'm not going to do everybody's individual request. I could go real quick to corn, March corn. This is right there. You caught me. But I'm not going to start doing that for everything. Overall, it looks as though here's, now I got to zoom in the area. April. Nope, we got to go to the end here. Looks pretty flat, very choppy in the last 5 years until the end of February. Then they get a little jump. Last 5, 15, and 30 years. So not really a good time to buy corn until the 27th. There you go. Now, is that going to hold true this year? Maybe, maybe not, right? You go out to the contracts. And yeah, it looks like it's holding true so far, sideways, and there's potential for us to rally at the end of the month. Well, we're bouncing off of, this is weekly, by the way, kind of bouncing off weekly supply right here and sandwiched between weekly demand. So is it really a surprise if we're going sideways? Well, again, seasonally, we should be going sideways. And of course, the chart showing us going sideways as well. Okay. So going back to one of the websites I went to before, FinViz, and not only FinViz, but I'm also going to go to, actually, I'm going to go away from that one, stockcharts.com. So with stockcharts.com, I go to charts and tools, and I do a weekly video on YouTube, by the way, if you're not familiar, called the Wendell effect. I actually talk about this every week and I follow it. You know, here you see there's some seasonality, but what I was going to go to here is performance charts and look at sector ETFs. So they do a charting of the different sectors. What do we have here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So they show 11 sectors here. Okay. Used to be real estate was under financials, but they separated those. Anyway, we can now look to see what is potentially the best performing sector. Now, this is not looking forward, it's looking back. But before I go to this, again, I want to go back here since I got interrupted looking at March corn. But going back to MRCI, here we have a trade outlook. And I believe they also here do seasonal action reports. So I'm not going to go into all the detail. You can get a 2-week free trial, by the way. They have a 2-week free trial when you subscribe here too. But going into those reports, they actually explain what is likely to happen. Oh, that's a report of the trade. Sorry, that's not what I was looking for. Not even here. You know, after so-called Santa Claus rally, stocks run higher into January. There appears to be usually some profit taking. In February, stock markets have usually begun to rally again into late mid-month. Notice the NASDAQ strategy published would have suffered a drawdown in only 7 of the last 15 years. So you talk a little bit about fundamentally what is to be expected in each of those categories or different asset classes, which is kind of nice. And there's some more detailed reports you can get via email and also on the website as well. This again is MRCI. A lot of good information here. So again, long-term interest rates have typically declined. Could be taxpayers are buying long bonds to defer taxes, or the government's doing yada, yada. So they explain fundamentally what they expect to see happening and how that can translate into price movement. And that's really neat to have, obviously. So that's another tool that's part of MRCI. So it's not just the seasonality, but also looking at what normally drives that seasonality to understand should prices keep going, or if we notice that something's happening. You know, interest rates have typically declined. They're not declining this year. You know, Jerome Powell is raising interest rates. So what does that mean? The typical seasonal patterns may not come to fruition this year. We may see something different. And it's good to be aware of that, to know what the normal pattern is and be aware of what's actually happening around you to see if there's going to be a change in your actions. And of course, change in price action. So I started to go over to sectors because again, this was assets right here. These are looking at the different assets. But going into individual sectors, once we have decided, okay, maybe we want to invest in the stock market, I can look to see which sectors are best performing right now. Be careful. This is showing you how they're performing in relationship to the S&P 500. You got to take that out to see the individual sectors and actually how they're performing. Okay, I don't care how they're performing versus the market. I care about how they're performing, period. And we can look, I don't like to look less than 6 months. And you can look at the last month or so, but really to get a good feel of where the economy might be and where the stock market might be, 6 months is a kind of good barometer to use. And we see that the best performing sectors are energy, financials, industrials, and materials, and everything else is negative. Okay, so what do we do with this? Well, the nice thing is on this website, just a little further down, they have what's called the sector rotation model. And again, in previous videos, I think I've talked about this as well. So you can go back and look at our YouTube website, our YouTube for wealth builders. There should be some other coaches corners, or I'm sorry, Trading Coaches Playbook. So what happens, the way you read this, orange is the stock market, blue is the economy. The stock market leads the economy as people speculate in the stock market as to what they see in the future of the economy. So if energy is leading along with some materials and industrials, it puts us right near a market peak. Well, what comes next? Sector rotation. If the market starts to go into a decline, we have what is called a flight to safety, where people are afraid of their investments losing in value, so they rotate their money into safe havens. Some of those safer sectors are consumer staples, healthcare, and utilities. Really, consumer staples and healthcare. Okay, consumer staples are things we use no matter what. Hopefully, because we go into recession, you don't stop using toilet paper, please. Right? Believe it or not, alcohol is a consumer staple. People don't stop drinking. They might drink more when the market's bad. And healthcare, we don't give up on that. Even if we get laid off, typically people will go to Cobra and try to get everything taken care of before they lose that care. Now, be careful. Doesn't mean in recession, those sectors are going to perform well. It just means they will perform better than the other ones around it. And by seeing which sector is best performing, now you get an idea of where you are in the rotation of the stock market. That's the best way to use this. And of course, you see the economy follows. So if we get a collapse in the stock market, the recession should follow by several months. This book is very expensive. I think it's a few $100s right there. No, the sectors do not change on the rotation. This has been this way for many, many years. And you can actually look back, unfortunately, it's starting to drop off. But if you go all the way back, December 2007 is as far back as you can go now. And if you go to the bottom of the market in 09, March of 09 was the low. March 5th, there we go. It's close enough. You can see the best performing sectors are staples, healthcare, and utilities. They're all still negative, but that's what you would expect nearing the market bottom. And you'll actually see the rotation go. If we did it versus the S&P, you see they look positive and you might be thinking, oh, I can make money by buying staples. No. They just outperformed the S&P. Overall, everything was negative in that crash in 2008. Okay. But, going forward, you see how real estate started to pop off at the bottom there because you're getting that sector rotation. Now, a little bit further down the line in October of 08, we're starting to get consumer discretionary, consumer services, and technology coming out of the bottom of the market. It's showing you where we are based on that rotation. Again, bearish market nearing the bottom. These are the leading sectors. We're right in here. Then it rotates. There's that pop in real estate. Financials were a little late getting off the starting block there, but you're starting to see that's the market bottom. Moving forward. Now we're getting the bullish beginning with these guys leading. Now it's not always perfect. And there's energy starting to climb, inflation, and it goes back and forth. But overall, now is that big thing, inflation right there, talking about the top of the market, right? Why is it the top of the market? Because when energy is leading, we're in an inflationary environment. That's where the Federal Reserve steps in, starts raising interest rates to start slowing down the economy. Utilities, by the way, they typically benefit when markets are sliding because the Fed will be cutting interest rates to help save the economy. They're not doing that right now. So utilities are not going to be a good buy during this bearish market. Again, you got to understand what's happening in the world around you to make sure you understand fundamentally where you should be putting your money. And right now, it appears that we are going into a market decline. And you take a look back, the NASDAQ, yeah, we've been in a market decline for a while, or the ES, or the Dow. We tried to rally out a little bit, consolidation, we might be at a little peak right here before we start dropping again. So that's where sector rotation can help us out. And the other nice thing is, anyway, that was stock charts, by the way, just real quick, going back to that stock charts under the charts and tools performance and S&P sector ETFs. So if I want to know which sectors not sectors, if I know which sectors are likely to be performing well going forward, we can then start to look at which industries might be doing well inside of those sectors. And one way to do that would be to look again to FinViz and the map of the markets. In the FinViz map of the markets, you can do the full market or just the S&P 500, whichever you choose. Or if you want to stay a little higher level, you even have ETFs under these maps. I'll show you right here. You can see we either have S&P 500, which will show obviously the 500 stocks in the index, World, which we said will show you all the different stocks globally that are listed in the US, full market, or ETFs. ETFs are nice for longer term investing because they spread your risk out over multiple securities. You're basically owning a group of stocks or a basket of stocks rather than just one individual stock. So the advantage is you reduce risk. The disadvantage is the returns are lower, right? Because you're buying multiple companies rather than just one. And you can see they're divided up into things like sectors over here. So we have the different sectors represented. If we know that healthcare might be a good sector, instead of buying one individual stock, we could buy XLV, the sector for healthcare. And if you want to know what are the individual securities inside of that ETF, you can look it up on a bunch of different financial websites. And for instance, if I go to marketwatch.com and just get a quote, XLV, there's a section right here called holdings, and it will show you the top 10 holdings of that ETF. UNH, Johnson Johnson, Merck, Eli Lilly, and so on and so forth. So you can see who are the big names that will influence that ETF. But the nice thing is I could go out and buy the leader, UNH. However, if they have a bad quarter or a bad year, that's going to sink my investment. But if I have multiple companies in the ETF and one company is suffering, it may not drag the entire sector down, unless, of course, it is UNH. This is the biggest weight, obviously. But if, say, Thermo Fisher had a bad quarter, it might pull back the XLV a little bit, but other stocks might be able to hold it up for you for your investment. So if I go back again to the map and go to full, or even any of these S&P 500 or full, you'll see they're divided into sectors: technology, communication services, cyclical, defensive, and so on. But if you zoom in a little bit more, and I'm using the wheel on my mouse to do that, let's go to healthcare since I was talking about that. Here's the healthcare sector. There's an industry: drug manufacturers, healthcare plans, biotechnology, diagnostics, medical, and so on. So those are the sectors inside of these are the industries inside of the sectors. Industries inside the sectors. Again, we're just following this map right here. We want to invest in the US. We've decided that stocks might be a decent investment. We found a sector that might perform well. Well, we can go into the industry and either trade the leading company or trade the entire industry using an ETF if we choose. So going back, let's say we wanted to do medical. We're going to look back about 6 months and see the performance and which might be leading. Zoom out a little bit. I'm seeing a lot of green over here in medical care facilities. So I can investigate that a little bit more and find out, okay, first of all, is there an ETF if I just want to invest in the entire industry? Well, we can look that up. Okay, there is a website called ETF Database. It actually got changed recently. They changed the name, but let me just do this. Oops, didn't mean to do that. etfdb.com. Yeah, I changed it to Vetify, whatever that means. So if I want to, I can go ahead and search. I think it's under tools. Yep, ETF screener. And you start looking, let's see, utility attributes. I just got to go through. I don't know all this stuff for it, but we can find even individual industries or holdings. You can actually look for individual securities too. I might be able to just do a search right here. And we were looking for, what was it, healthcare, medical care facilities. And let me go back. Here it is. So I just do a search and it doesn't really show anything yet. Healthcare index, there's an ETF tracker there. Healthcare index, long-term care index. So we can take a look at that and see ETFs. There we go. Now that's the healthcare overall. And we can try to find something that might match US healthcare ETF, IYH. And another thing we can also look at, and there's healthcare alpha dex there, and you can take a look again for the individual holdings inside of that. Or when you take a look at the map, HCA, UHS, you can either invest in some of those leaders that are performing well and leading that market, or even look for ETFs that contain those securities. So you can do those searches as well through the ETF database. So I take a look at, say, HCA, or what was the ETF we found here? I'll try IXJ. This is a weekly basis. It's pulling back a little bit, might be giving us an opportunity to buy in on the pullback to this demand. It's still very bullish, just a small pullback. It looks like a bull flag, doesn't it? Daily chart doesn't really help us too much there, a little bearish. Or, as I was saying, we could take a look at the individual stock leader, HCA. And that looks pretty bullish as well. Obviously, want to wait for it to pull back to buy, either on a daily basis or weekly basis. And now, because we look to see what is likely for the rotation, we saw that we were likely to move into healthcare, right? That may be one of the leading sectors. We went into that sector, found an industry that's leading right now and might continue to. And through that, I ended up finding one of the leading stocks. Now I just have to use my technicals to figure out the timing. Fundamentals don't really give you the timing, when to get in, when to get out. However, they can give you an idea of where to look. And then I use the technicals to get the timing. So I kind of, use it all to figure out what to do, either shorter term or longer term. And it's been benefiting me for quite some time. I don't believe that one solution is best for all. However, for day traders, you really don't need to do any of this stuff, obviously, because you're just in for the quick momentum. Even if you're doing short-term swing, it may not affect you much. But for long-term investing in the markets, fundamentals do come into play because they are going to influence where the markets might move. And there's a lot more to this. I only scratched the surface. I'm running out of time, unfortunately. If you're interested in learning more from me, I do talk about some of this stuff, as I mentioned before, primarily in the Wealth with Spreads program that I run. I think I have, there's my member page. I'm logged in right now. I run a couple different programs for Wealth Builders HQ. The E-mini think tank, the link was up for that earlier. That is futures trading. We do short-term day trading and longer-term wealth building. I also do the Wealth with Spreads program, which I just mentioned. And that is where we are investing and looking at spread trading in futures. So it's a little more advanced, but because we're doing one contract against another, it typically reduces the risk. As a matter of fact, I want to see if I can find, I have Excel open still. Yes, I do. Good. Oops, can't see anything. Got my stuff covered. Trade tracking. There we go. E-mini think tank trade tracking. Just want to show you that. I track everything I do. I put out trade ideas in each of the classes. This was January's in the trade tracking. All the trades are tracked. Unfortunately, there's a lot of them we don't get into. I find trade opportunities, 57 of them never hit. That's the majority. As a matter of fact, I was not a great picker this last time. I had 18 winners, 17 losers. At the end, it didn't really matter. You know why? Even though I was only right 51% of the time, I keep the losses small in comparison to the winners. That's how you make money in the markets. You don't have to be right all the time. I'm right all the time. I'm wrong all the time, I should say. I'm wrong all the time. Just ask my wife. But, when we're wrong, we just need to be wrong very little when it comes to our trades and investing. Let me see. I have the wealth with spreads. I want to show that one. January. Wasn't as strong. I think this is it. January wealth with spreads. Yeah. And there's still some trades that are open, so the numbers are going to change. As a matter of fact, there are 5 open positions right now, 2 that are still pending. So that one had a little bit better of a win percentage. And again, these are winners so far. We'll see. Thank you. They are pretty awesome results. I mean, this is what I've been doing for years and years and years. And now I just share that knowledge and that opportunity with you, my students. And anyway, hopefully you enjoyed this class. If, like I said before, if you want to get involved with some of the programs that I have, you can go ahead and contact us, support@wealthbuildershq.com. You can also use the links. There's always a 2-week free trial if you do the quarterly subscriptions for any of the programs. And I would hopefully love to see you in those programs in the future as well. Let's see. Jim's asking a question. Use the Russell 2000, see how the economy might do January in this class. Oh yeah, back in Friday. I think I noticed with, with the fundamentals that could possibly go down. Yes. The Russell, the reason why I like to use the Russell is because it is comprised of stocks that are pretty much have all of their business within the US border. They're not multinational or as much. So if we take a look at the Russell, let me just clean this up a little bit. This gives you a better idea as to what's going on in the overall economy inside the US. The problem with the S&P is that it is more focused on multinational companies, international exposure. This gives you the US. Now we're in an uptrend, higher lows, higher highs, but we're struggling to maintain that, right? We can't seem to break out of this major peak right here. And the momentum, which is something I use very heavily, the RSI, the momentum just never really got bullish. You take a look to see, excuse me, losing my voice here. On a daily chart, we can go to the beginning of this year even. I think that's it. Nope. Right there, beginning of this year. Who's leading us in which direction? Oh, the NASDAQ is, but there's the Russell. And notice those leaders gave up. And since the leaders are falling down, they've been dragging everybody up. The laggards are likely to fall as well. So yeah, I've been using the Russell for many, many years to look at what's going on inside the US economy and to see what is likely to go forward. So with the sector rotation model showing we're at a peak and getting ready to drop, here we're seeing a lack of momentum. If we were going to continue to make new highs, we should have gone above 60, showing we had lots of bullish momentum. We topped out right about 60 and are going sideways. So if we start to break down, especially if we break to a new low, then the uptrend is over. We resume the bear market. And I do see that happening this year. In the meantime, we're going to be a little bit choppy for the next, maybe the next quarter or so, to be honest with you. Summer looks like it might be a bit sideways and kind of lagging in real momentum. But third to fourth quarter this year, we might start to see more of the bears popping out. So that's what I'm seeing. Yeah, you're welcome. And I mean, we're at supply right here, although it may have been a tested supply zone right there. So thank you very much for being here. I got to run, unfortunately, but hopefully you enjoyed this and got some good information. Like I said, I'd love to see you in the classes in the future. At the very least, pay attention to these Friday classes. And there's also a lot of great free information on Mondays in the Power Hour as well. So keep in mind, Monday is a holiday. So we're doing the class on Tuesday for the Power Hour this month. So I will see you again soon. Trade safe, trade well. Take care, everyone. Thanks for being here.